Policy convergence is the new reality in Washington, but for markets and the economy, uncertainty remains. With signature moves on tariffs and taxes set to take effect, what's next for the Fed, deal making, and the broader outlook? We're going to break that all down for you right now on UBS Trending. Hello, everyone, and welcome to UBS Trending. I'm Anthony Pastore. Thanks for joining me and my guest, Paul Shao, asset allocation strategist with the Chief Investment Office here in the U.S. Paul, good to have you back in the studio.
Thanks for having me.
I think we need to kind of start right away, since we're talking about the side of the story that impacts businesses. We have to look at that labor market data that came out recently and how it surprised everyone to the downside with revisions for 2 months and a much lower than expected rise in payrolls. When you look at those data points, how does that factor into what you're looking at when it comes to sort of company policies and what their hiring practices are or have become in the last few months?
Yeah, so if we really look at perhaps last year, we've come out from a very strong labor market, strong growth environment. And even before the election, we were expecting both growth and the labor market to slow down in 2025. So a slower labor market isn't necessarily a big surprise. But over the last couple of months, as you've mentioned, as what companies are saying, the impact of uncertainty, tariffs, perhaps a little bit about the current bill that's being passed has affected ways that companies are thinking. And we've had different indicators of the labor market showing a lot of the labor market has stalled. Hires rate, the openings rate are much lower than they were once before. But job creation has been surprisingly robust over the last couple quarters, which is good for the economy, but it kind of puts the Fed in a pickle. And that's been going against the other data that's showing that at least households are saying that their job prospect findings are much lower than they were before, and companies are seemingly saying that they're loath to hire. So this recent set of data that shows revisions, I think comports much more with the sense that labor markets are slowing. And right now, it isn't quite recession yet, but it should worry that this is definitely a growth scare in the labor market data.
Right, and I know that CIO research is still saying that they're not calling for a recession at this point, and still calling for 100 basis points of cuts by the Fed over the next year. When those cuts fall, in which particular meeting is still up for debate, possibly September. And interestingly, too, we're seeing consumer spending data declining as well. So that must give corporations and companies a little bit of pause about what the next few months into the year look like. And when you think about that, we're also thinking about the trade deals and the tariffs. There have been a number of trade deals that have been announced, some that are still kind of in the back and forth phase, Switzerland, China at this point. How are these developments, or maybe even some cases lack of developments, impacting business?
Right. So after Liberation Day, I think we had the phrase 90 deals in 90 days come out. It's been far fewer. But
That's right.
Even added to that, we have a growing development that the IEEPA courts are looking increasingly unfavorable to the legal basis of this tariffs, right? Which means that even if he doesn't complete 90 days and 90 deals, it's unclear. Sorry, even if he does complete 90 deals in 90 days, it's unclear the legal standing of these trade deals. But regardless, I think right now, it looks like the increase of tariffs is very much within CIO's base case from the year, where we did see tariffs increase meaningfully from the pre-election basis, but not to the the sort of rates that are announced election day, post-Liberation Day. And the sort of band that we were talking about the last time we were here about like between 10 to 30% of tariffs, depending on the trade relationships with the US, I think are largely in place with the trade deals. And I'm putting that in quotation marks because it really takes years for deals to be made, but these announcements seem much more, with very few details right now, but they do seem to comport within that 10 to 30%. So there is more certainty on the trade deal front, but for consumers and for the US economy, it does mean that there is an inflationary shock that is yet to be fully absorbed by the economy over the next few quarters with the impact of higher tariffs.
Great, thank you, Paul. And just for our viewers who are wondering, IEEPA is an acronym. It stands for the International Emergency Economic Powers Act, which does give a sitting U.S. president broad power to institute and enact on tariffs, but they have to be under emergency protocol. So there's some debate on whether or not IEEPA will allow these to continue, et cetera. So that's what's going on without getting into the politics, but all that's just the facts. I talked about CIO's expectations. What is the Fed thinking? Now, we know Powell is under the gun to cut rates because the administration is, kind of asking, maybe more than asking to do so. And we have one Fed governor who is quitting and another that will be replaced. By the time I'm sure this airs, we might even have a name on the list for that. What's the Fed thinking, and what does the rate cut environment look like when it begins happening?
Right. So I think for a lot of market participants, even from the beginning of the year, this really puts the Fed in a difficult position. I think since they started cutting rates, I think the direction of travel that the Fed has pointed towards has been largely correct. Like the rates were too high, above neutral, and they were coming down depending on how inflation will go. And the impact of tariffs, as you can see from this chart here, that makes the job for the Fed harder in order to cut rates in the future. The sort of irony about the White House firing the BLS chief and the expectation by markets is that the numbers might be inflated, is that if you have stronger jobs numbers, that also complicates the job from the Fed, because high inflation and strong jobs means no rate cuts. And that's something that the White House seems to say that they do want. They do want rate cuts. So somewhat ironically, the weaker labor numbers that we saw in the beginning of our conversation, right? That really amps up the case for rate cuts starting in September. And as you mentioned, we do expect several rate cuts to take over this year. But with this really much weaker labor data, it does seem that we will see rate cuts throughout the next couple of months.
Yeah, it seems a little contradictory then, as you were saying, from what the administration wants and what the Fed needs to do. And if there's higher jobs numbers, it takes a different turn to what the Fed should be doing. Yeah, long road ahead for when it comes to what happens next, Paul. Thank you. So I just wanted to kind of wrap it up with the M&A side of the story, because it seems like deal volumes are up a little bit, but transactions are down. So what do you think is causing this disconnect, and how much of this is being caused by the uncertainty that you and I are talking about right now?
I think for a lot of companies, they realize that right now it's really transformative moment, especially when it comes to AI. So there is pent-up demand to make deals, to make strategic acquisitions. And that's something that we've seen over the last year or so. The issue always has been higher rates, but also the disconnect between valuations. And then if you layer on top of that now policy uncertainty with tariffs. For example, manufacturing companies, right, if they want to make a strategic acquisition at this point, right now, if you add policy uncertainty, it's sort of like dancing with the lights turned off. It's quite uncertain, but you might still want to get some moves on. But for a lot of companies, so with deal making volumes up and transactions down, it means that a lot of larger scale deals have been made. And from what we've been seeing, that's largely focused on AI capabilities. Now, when we sort of talk to mergers and acquisitions executives, right? One of the things that's limiting transactions is still the valuation gap with a quite expensive stock market right now, and public markets doing quite well. So the problems are still the same: high interest rates, valuation gap, policy uncertainty. But I think going forward, we will have low rates in the future. And when it comes to policy uncertainty, I think that will also diminish, because it's hard to imagine, at least from a market perspective, to have a repeat of the last couple months when we had the drama over tariffs, the drama over the tax bill playing out over the next couple of years. And with those sort of policies converging over the next couple months, less uncertainty, but those coming to fruition, I think that will help the M&A landscape increase.
Great. Paul, thank you very much. It's a big story. All of this combined allows for interesting conversations like this. So thanks for coming by, and I'm sure we'll have more to talk about the next time you're here.
Yeah, thanks for having me.
Great. Thank you, Paul. Paul Shao again from the Chief Investment Office. Thank you all for joining us again. For more information from CIO, you can check out our UBS Insights page at ubs.com/views. Plus, you can follow UBS on social media. We're on LinkedIn, Facebook, and Instagram. We've got a dedicated studios page there. You can follow us at UBS Trending. So take a look at that when you have some time. And as always, if you would like to continue this conversation, please do so with your financial advisor. Until next time, I'm Anthony Pastore. We wish you a great rest of your day, and remember to keep your eyes on what's trending. See you soon, everyone.